In this video, we will fully understand all the most famous patterns in trading, which can make it easier for you to trade on the crypto market and Forex. Let's get started. First pattern, head and shoulders. This pattern is formed in an uptrend at price highs. It has three upper points, the notional head in the middle and shoulders on the sides plus two lower points. The notional neckline should be drawn through them. When the pattern is well formed, price falls below the neckline after the right shoulder is formed. The price is likely to fall by an amount equal to at least the number of points from the neckline to the top of the head. Sell immediately after the chart breaks below the neckline. Once you have identified the head and shoulders pattern in an uptrend and the right shoulder has formed, you can open a sell order as soon as the price breaks the neckline. Wait for the candle to close below the neckline before entering the market to avoid a false breakout. The second pattern, inverted head and shoulders. This pattern is the opposite of the previous one and is formed at price lows when the trend is downward. Accordingly, the head and shoulders are located below the neckline, not above, as in the standard pattern. After breaking the neckline, the price is predicted to rise by the number of points, at least not less than the distance from the neckline to the top of the head. At the moment when the neckline is broken, the purchase of the asset is carried out. Once you have identified the inverted head and shoulders pattern in a downtrend and the right shoulder has formed, you can open a buy order as soon as the price breaks the neckline. Wait for the candle to close above the neckline before entering the market to avoid a false breakout. The third pattern, double top. This is a local trading pattern that is possible in case of an uptrend at the price peak. The pattern is formed by two equal or approximately equal price tops with one local low between them. After the end of the figure, a downtrend is predicted, at which point a sale is made. When the market reaches an overbought level, it may encounter resistance and form a double top pattern. It starts from the first high, when the price retreats until it finds local support. At this time, you will not be able to detect a pattern. After the first top, price pulls back to support, neckline, and then bounces back to retest the resistance that was just formed. If the price fails to break above it, it will form a second high. This is when traders are wary of the trend and should be ready to go short when price breaks the neckline. The fourth pattern, double bottom. Like the head and shoulders, the double top has a mirror version that forms on a downtrend near a local low. The two lower points of the mirror top are marked on the price lows, with the point of the local maximum between them. When the formation is completed and the baseline passing through the point of the local maximum is broken, the asset is bought with the purpose of selling it at a higher price because after the double bottom, an uptrend is predicted. The fifth pattern. Wedge can be formed both at the highs and lows of the price. This trading pattern squeezes the chart between two lines, a support line and a resistance line. Within the lines, the price can go up and down several times. The breakout is considered to be the output of the chart below the support line or above the resistance line. In the first case, it is a sell. In the second case, it is a buy. A wedge is graphically similar to a triangle, but not identical to it. It belongs to the reversal patterns. Indicators define this pattern well enough, as well as most of the classical patterns. The sixth pattern, triangle. This pattern can be equilateral, ascending, or descending. All three types either continue a trend or reverse it. Unlike the wedge, the support line and the resistance line are completely crossed. Further buying-selling is done, depending on the type of formation and trend. In an equilateral triangle, if the chart breaks above the resistance line, buy; if below the support line, sell. If the chart breaks below the support line in case of a descending triangle, sell. Seventh pattern, rhombus. This is a rather rare market reversal pattern that can be formed during any trend at local lows, maximums. If the rhombus appeared at the highs of the price chart, it indicates that the upward movement is over and now you can sell. If the pattern was formed at the bottom of the chart, after the downtrend, you can wait for an upward reversal and get ready to buy. The rhomboid pattern most often occurs after a long trend phase. Eighth pattern, flag. The flag pattern predicts the continuation of the current market trend. It consists of two parts, the flagpole and the flag, the channel in which the price moves. The flag corridor can go strictly perpendicular to the flagpole or with a slight inclination. Its general shape can correspond to different figures: triangle, rectangle, or wedge. The correction is completed by the exit of the price beyond the resistance lines. At this moment, the purchase is carried out. If the trend is down, everything mirrors the uptrend.